Looks like we had a little Microsoft upgrade over the weekend, and we're just getting our things together so we can record this out and practice the recordings, making sure all the recording devices are good. So everything's looking good. I hope everyone had a good weekend. Looks like there was some storms. We had some incredible rain event here on Saturday in Florida. But the children, it did not rain on their soccer practice as much as I would have actually preferred. As the assistant coach, who is considerably out of shape, these little, it is fun to watch the little beehives, the two different groups, the 5-year-old and the 7-year-old. And then after soccer practice, all the kids got their workouts in, and I guess there was a tradition where before the actual season begins, parents play the children, which was very interesting because the parents did not give up. They were competitive as if they were playing against their equals. A lady just kicked a ball as hard as she could and scored a goal, almost knocked her own daughter over. I mean, it was pretty interesting. Funnier than Dickens, actually. And then it rained. And then it rained. It was Forrest Gump rain. And I noticed some posts in here. It sounds like, Sonia, we must have sent that rain up to you because, I mean, it rained here. All right, 9 a.m., let's hit the start button. Good morning, good morning, good morning. Sound check's good, everything's been done. All right, here's what we have this morning. We have a stock market that is, on Friday, a surprise upside move, pretty sizable pop with the AD line on the dailies, meaning that there was, some good contribution towards more stocks advancing than declining. I guess, if anything, we could say one more time, where did the volume go? So with that said, the volume actually, if we look at the last few days of the on-balance volume indicator, it has risen in the last couple of days. We saw an increase in the volume. And remember, I noted that the other week, or last week, that we have seen volume trends start to, as when we see volume moving up in the on-balance volume, there's been that detachment between volume histogram and on-balance volume, but not in recent weeks for a lot of different individual stocks, for example, and other indices. And I think what it is that we are getting less and less people just trading in the option market is about what it might seem like. We also discussed that over the last few weeks. We have seen what? Bid and asks widen abnormally, and so that tells you there's less demand in the option market as well. So it seems people are just, at this point in time, just in the stock market, or maybe it's just traders going back and forth. But needless to say, we had a situation on Friday where we were looking for a breakdown underneath that 88 area, and if you note, we were looking for that breakdown, and as the low was 88 and a quarter, it did break down below 88.75 by that 2-tick number and popped right back up again. So with that said, where are we going right now? We did see a strong move with the advanced decline on the S&Ps. The NASDAQ 100 certainly has barreled through. Again, no volume. So it shows that there is wide participation, but we want to see that volume action behind it. So we're back to where we were. No different. It's like the same old thing. Last week I said, hey, let's give this a couple days to see if volume comes back in. And volume did, and the market kind of sold off. We got a low closed doji. We did not negate that low closed doji or that PPS sell signal, so we need to be on guard for that. However, I hate to be giving you conflicting information. The AD line showing broad strength, good breadth in that particular index will give us a little bit of difficulty. This could change on a complete reversal. So what we need to watch for is if the market does not have any follow-through strength, in fact, starts to move again sideways or lower in the next couple days, we have to pay a strict attention to the AD lines as it relates completely to the NASDAQ 100 or the Qs. Looking at the Russell, I'm just taking each sector individual, each index as a sector individual, from blue chips to tech-weighted, biotech, and of course, one of the stocks that are that has an impact besides Apple is Tesla on the NASDAQ 100. When we switch gears and we go to the Russell 2000, which is considered a growth stock index, in booming times, people pay for growth stocks to look to perform over time. And as we noted this whole year, this has been the quandary. There's been no major participation in the Russell 2000. Truly, we do see at the end of August, the Russell typically outperforms some of the other markets, and it hasn't happened this year. So we're still right back in the same boat to where we were. We're in a, as you can tell, a pretty substantial time frame of a range in this market that dates back, if we can even go back a little further. I mean, look how long this kind of wide band range has really lasted in the NASDAQ, and we can go back from these highs right here when the market established those highs, and then of course came back and tested that old resistance, now new support line. It came again and tested it here, it came again and tested it there, and now recently we made a higher low. However, we've made a lower high, and you can see as I'm defining kind of the upper end of this channel that we've established over time. And since we started the breakout here, which was back in late September of 2013, it's been a sideways market. So is there a chance for this thing to break out? Well, the advanced decline would suggest it's not really seeing a lot of momentum, and certainly if you take a look at the volume, it suggests equally there's a lack of momentum or interest in getting into the Russell. So that to me is, you know, another red flag. We need to watch that. So there's two cautionary things that I want to watch this week for, and that's a breakdown of the advanced decline, and also in the NASDAQ 100, and also I want to watch for the Russell market participation. I think for market timing, and that's the difference between looking for individual trading opportunities and market timing. That's why we go through on Mondays in weekly planning and scanning. Let's take a look at the health of the market as it exists in all the top sectors. And we take a look at the NYSE, New York Stock Exchange Composite Index, noting that while it has 50% or more of its components as interest rate sensitive preferred and bond fund instruments contained in it, that's why we want to take a look at all the various stock indices. And as you can see, we're pressing to these highs. Volume hasn't broken out, and of course the advanced decline is at the very least on a daily basis marginally confirming that this market has some positive momentum, which means it's neutral. It really doesn't say, hey, game back on, let's get excited to the long side here up at these new highs. And the same can be said with the Dow, and I think that that's one of the things that anyone that's looking at the volume participation would say, listen, if this thing's going to break out, we really want to see a good breakout with the advanced decline, and there's only 30 stocks to follow, as well as volume. So even the Dow is just kind of showing us what I think we all kind of know and see. Nothing's really changed in this market. When I change to going, okay, well, let's take a look at certain stocks and what do we see happening for this particular week? Well, we've got a boatload of information, and if you go down to your document tab that I have illustrated, you can go and get your weekly sheets. And I think it's interesting that we like to teach all good things come to those who wait. This is a waiting game. It's a game that you get paid to wait. You get paid to wait for once you're in a trade, you wait for that trade to mature once the trigger occurs, and then you wait for the right setup before entering a position. And I think that is a good lesson for this week. In addition, this week, we want to remember 9/11. Interesting that we are going to be in New York on 9/11 at a conference that is, I'll be speaking on the 12th, and I will have a chance to go down to, as I did in February of 2002, Ground Zero, and kind of has a special meaning for me. I did have some friends, some people that we knew that had fell victim to that terrible tragedy. So we want to still pray for not just the victims, but the family of the victims, all those children who grew up with that horrible, just no words for it. So this is 1 week that I think we all have as Americans in our hearts and our minds. As far as the markets are concerned, we did see last week the biotech seem to respect a seasonal weakness. We want to watch the stocks, the semiconductors, and the XCI, because this is actually, believe it or not, the end of this week and the next week is when we see that seasonal peak for these sectors. And it seems that, like social media, Baidu, they're making Baidu's breaking out. It seems Alibaba, the IPO, is a big thing. Social media stocks, the world is just amiss with getting into this momentum here. And that's what I think is really an interesting aspect about this market, is people are just short-term trading rather than looking at longer-term investments. And that, to me, is another cautionary standpoint. One other cautionary standpoint I want to make mention is that the commitment of traders data reveals small specs are still net long and even more committed to the long side. And I also noted that both commercials and professional speculators are net short. So I would say we need to watch for a mid-month turnaround or peak in the NASDAQ 100. And since, again, I want to reiterate, biotech and computer technology tends to peak during the month of September. Last week I said we have 2 important pieces of data. The Beige Book, which this market last week, just to take you down memory lane, Beige Book had no impact. It's as if I thought it was a delayed release and that our reporting information services got it wrong, that because of the holiday it wasn't going to come out Wednesday, it was going to come out Thursday, because it had the market had literally no negligible reaction to the Beige Book report. When the monthly unemployment numbers came out, we saw a small little spike up, market came back down, and then all day we just saw that kind of grind up through as it started to hurdle above little pivot resistance, then old chart point resistance, then the 2,000 mark, and the next thing you know, towards the final minutes into the day, we rallied as if people were still clinging to their shorts as day traders, and the market ran right into the highs, into the close. So here we are, we wake up, we're back into the market as it looks to press against this magical 2001.25 support number, which was the resistance that we had on Friday in a big number, as I'll share with you all week, 2001. So the question begs, is 2000 the launching pad for a new leg to the upside, or is 2000 area just seeing us digest the markets and absorbing the market supply, so to speak, like as in distribution? So that's one that we use the on-balance volume indicator for, as well as the breadth analysis to see if that's true. So I thought that if there was any positive news, it would have been factored in the current market's price. Positive news would be if we had a stellar unemployment number. The only thing that would have been really bullish for the market would be that if we had a really bad employment number, then mostly it would be bullish because it might signal to the Fed not to be quick to raise rates. And with European central banks lowering their interest rates because of their expected decline in the recessionary type environment in Europe, then this was why I was saying, listen, if the market is going to continue to be fueled on free money from the Fed, we don't want to see an aggressive growth rate here in the U.S., and that's exactly what we got. It was just more free money Kool-Aid theory from the Federal Reserve. But in any event, we could see a potential longer term, and I'm giving a longer term for this, not quarter, but between longer term now and, say, I guess in this environment, the elections in November, which are really not great, but there is an election coming up in November that we need to be aware of. Congress comes back to work. We get them back from the summer break. We've got fall starts. I believe it's next week. The first day of fall is actually next week. This week, as we get through our list of things that we have to pay attention to this week, I still think that we could see, if we do get a 1 to 3% appreciation, which means the S&Ps go up anywhere from another 1 to 3%. But I'm thinking, as we've been talking about, we did a special little session last week about going longer term. The martingale kind of options are like, put something on longer term. I did a nice video for bottom line subscribers and defined things, and I'll just go through this. Maybe a lot of people tend to forget about corrections that occur in bull markets. And the media, I find it interesting, the media is saying that from the greatest bull run, a 17-year market run-up, but you know, in the 17-year market run-up in the 80s and the 90s, let's not forget about these events that do happen, these short-term, God knows why, but they happen, corrections that start from 10, 20, and even 30%. So I did the research for you guys, and I just leave you so you could go back and independently look at the SPDR or the SPX, the cash market. And now, granted, a lot of times the pricings, it's a very small muted move, but even if you look at the crash in 1929, we had some pretty significant moves. So let's just look at this little time period from 1978 to through 2000 was one of the greatest bull runs in the market. We had corrections in 1981, 1984, notice the 3-year difference, 1987, another 3-year difference, 90, another 3-year difference, 94, a little more than 3 years, 97, 98, not to mention the major 51% pullback from the peak in 2000 to the bottom in 2002. And let's not forget, we had about a 58% correction from the peak in 07 to the low in 09. So I guess corrections like the 22% correction made in 2011, people kind of have forgotten that we do have little corrections that go along the way of bull markets. And I guess that 2011 correction of 22% does pale in comparison when you think about it, up against the 51 and 58% corrections in that we experienced in 07, and of course the 51% correction from the peak of 2000. So those are substantial pullbacks, and whether you want to blame long-term capital management, the Asian currency crisis, overbought market condition, the invasion of Iraq, 87 was, you know, we blamed it on Asia and banks, 84, to be honest with you, I don't really remember what the little mini crash in 84 was. I wish I did. I don't remember it, to be honest with you. Then the one in 81, you know, we weren't trading S&Ps in 81, so I guess I was impervious to it, and I was working for George Lane, so I was more interested in, I guess we were working on cattle and the grains. So with that said, as a trader going through the history of time, I understand that we as human beings, we get complacent and we forget. And I think we shouldn't forget, and we have to understand that even though there was a period of the greatest bull runs, if anyone's interested in why my message as we go through week to week, month to month, the longer we go, the higher we go without any little meaningful, sustainable correction, the bigger the correction may become. And so we take off, for example, to be truthful, we could take off 10%. So if a correction does occur, you might see something greater to a magnitude, like say 20%, or even we could see a more meaningful correction. If it occurred, the higher we go and the longer we go, we could see maybe a 30% correction. So I'm thinking the higher this goes without any meaningful correction and the more upside, while it's great for short-term trading, I think longer term it does behoove us to have a little bit of protection on as far as options are concerned longer term. So I think that if we do see trouble in China, if we do have trouble in a slowdown in Europe, I often say, gee, we are looking at a market, and I may have gotten a little bit on this week's thought provocative tangent here, but we do have, I don't know why a market needs to ever see a correction. After all, we do have needs, demand increases, we have supply-demand shifts. Global population does expand. We all need to eat. We need fuel and gasoline to get around. We need simple things like toilet paper. It's not really a luxury, but I think nowadays you got people that are texting and, anyway, I'll let you read that. I don't need to get into that, but I went on a little tangent, just a little humor, and I think I don't understand why people need to use their iPhones and text and communicate all the time and everywhere. I think we should probably have a little bit of solitude. But I think if Seinfeld was around, they would have had an episode about people using iPhones and talking in public restrooms. I guarantee it would have been a Seinfeld episode. Anyway, I do apologize in advance, and I put it in writing for going off subject, but any event, we always go back in time and we go, what sparked a market sell-off? The boat was loaded too long and someone wanted to take a profit. And very simply, at the end of the day, sell-offs are made when a few people want to sell lots of supply at higher prices than people are willing to pay. And that, my friends, is at the end of the day, that is really what makes the market go down. I like it as the Dos Equis commercial says, stay thirsty, my friends. I would stay thirsty for your own financial wealth and well-being. So protection, hedges, longer term, the higher this thing goes without any meaningful correction through history, I would rather have some longer term puts on just in case as we start to see and we scratch our heads and we go, why is this not happening? And we don't understand it. Eventually one day we will understand why there was lighter volume on this rally, why the AD lines didn't confirm with the Russell. One day we will get that answer. And if it just so happens it's because of a market internal weakness or a sell-off was near, I would like to have had some money, not a lot, but some money committed to longer term out of the money puts up here just in case things get ugly. And that was my message a week ago. So we do have the FXE starts out strong. And this is, even though we did have the euro currency on a typical year, and this is again not a typical year because the euro currency and the ECB, especially the European Central Bank, lowered interest rates. But today, actually it starts the 9th, by the way, tomorrow. And the FXB, which is the British pound. Funny thing is the pound is getting pounded versus the dollar to the downside. But note that we have mid-month strength. So it's down now. So we want to watch for bottoming actions in the British pound. Perhaps this little downside action that we're seeing in the overnight due to the independence vote of going on in Britain versus Scotland. Maybe this might have something that's happening here. Materials start to perform to the upside a little bit. And then also we see homes as like the last bastion of pickup in building before the ground starts to get frozen. We start to get a push for that little fall home buying. People go back to school. They want to have their homes in, et cetera, for the holidays. Anyone that's committing to a home will have it built. So ITB actually sees some strength this month. So does gold and silver. Neither are acting strong. These are the areas of weakness that we have for the market. The tech, as mid-month denotes for IBB, which is biotech, computer hardware. XBD is broker-dealers. Hogs, cocoa, crude oil denotes that we see weakness and mid-month weakness in crude oil. So we'll be looking for strength this mid-month. If there is no interruptions, supply disruptions from hurricanes in the Gulf, then this is where we get a really weak area in crude oil. So we want to watch for rallies as we get into the mid-month for crude oil, for sell down, for breakdowns. And I have a breakdown in crude oil. It's a last conditional change, a close below 92.55. During the week, we'll go through some of these. I'm going to be nervous on gold if we get a close below 12.60. Watch for daily closes above 12.91. Silver. Monthly support is 1853, and the reason I put that out there is, hey, we're near 1853. Monthly support, we want to watch that monthly support number because the silver is going to be strong. Maybe it bounces off a support level there. Also watch for daily closes above 1957. Bonds, daily last conditional change below 137.24. We noted that we had the knob spread, which was forming a potential daily head and shoulders top last week, which I'll share with you in just a few moments. But needless to say, we did break the trend line. We did break the neckline. It looks like we could come back up, which comes in at around 13.14, and that market is trading around 13.08. So let me go over and just do it as we're covering the information right away. And I'll go through that knob spread with you. And again, the knob spread is notes over bonds. And so if you compare 10 years to 30 years, and this is a spread that we've been, dealing with for 30 years or longer, I think now, 30 years actually, 30 years. Let's give this a shot to load up all the pages here, and we'll get this knob spread going. Watch the euro. We have monthly support in the euro at around 129. I did this the other day before with TradeStation, and we seem to be kind of bouncing off that area. Could take a few more days. We might see some inter-week support, but you can see where we have the old, as you look at a potential shoulder, head, shoulder, and it looks as if now we're developing even a bigger head and shoulders formation with an ascending neckline right here. The shorter term neckline that we were drawing off against this level, the market broke down below the neckline. It seems to be coming up, and I'll be honest with you, if this market breaks below this level, which on a daily chart, if we get below that swing low, note that we're starting to form lower highs and lower lows. And boy, that would be a consideration that perhaps it signals that interest rates are rising and things are normalizing, which means in a rising interest rate environment, bond prices should go down. If the Fed's quantitative easing and they stop their bond buying program, well, someone has to be buying bonds, and someone needs to be feeling that bonds are a safe investment up here. But I kind of think that we are actually forming a very long-term final last gas, and I say long-term in the sense that maybe for the rest of this decade, a top in this market. It's just forming a longer-term topping process. This is a quarterly going back since 1984. Why would I even say that? Because the market is starting to form a top. And that's why I think longer term for this decade, I'm talking for the rest of from 2010 to 2020, the next 6 years, I think that this market is forming that little top, and that we should start to form a relationship where we challenge the low end. The low end of this little, again, this is a quarterly chart, folks. And if you note that even back in 2010, the knob spread was trading at about, believe it or not, negative. It was negative almost 3, negative 3. We're at a positive 13. That would be about a $16,000, believe it or not, difference if we come back and test that low. So there's a lot in the knob spread to give up if we just trade back into the low end of the range. Where would bonds have to be? Considering the fact that knob spread, the bonds, we're down near the 116 handle. I think a lot of people had kind of forgotten about where bond prices can go. So in this environment with taking the, I think the short term makes people forget about the longer term, and then when it happens finally, then we all forget. So I think it's good to take this time period to say, hey, let's take a gander at these longer term charts, the quarterly charts. It's because I want to get you engaged and starting to acknowledge the fact that, guess what the month of September is? The end of a quarter. So we want to not just look at monthly charts, but quarterly charts and say, well, what is the change of scenery happening around the world? Another aspect of longer term analysis before I get into what areas of investments for this week I would look at is when we look at the relative strength and compare the U.S. economy or the U.S. stock market, which is a reflection of a leading indicator of the expectations of growth. And that's why it's a leading indicator of the economy. And sometimes it gets a little overpriced. But if we go back since the beginning of 2013, just to want to share with you, this is the beginning of 2013 when we saw that, government sequestration, right? Remember that? And we just took off. Well, we didn't just take off. The blue and the green is the Dow and the S&Ps. And then note that we did see a little detached relationship between the foreign German, Italian, and French markets. But then we kind of started to trade in tandem. Note that they started to trade back down, and they led the way down first, and then all of a sudden we saw correction lead or lag next with the U.S. equity markets. They started to break out. We all started to break out. Note that we've all started to trade almost in tandem. Note that the orange started to lead the way back down, and that is the EWQ. And then all of a sudden we saw the German EWG, the little brown, it started to come back down. But we all trading kind of in simpatico, in sympathy, in tangent. And all of a sudden, something happened right here. And we saw this huge detached relationship. And the one stock indice that is the thoroughbred, the leader, as if this horse is not going to run out of steam eventually. I look at this and I go, well, gee, all right, that's the emerging markets. I get it, which is this fuchsia color. And this is Latin America. After 2 years, wow, they're doing great. They are coming back, losing less, making a little bit of positive progress. But if the global economy, and we're so intertwined as a global economy, either these are going to go up and then start to outperform as people take money off the table here and put it to work over here, or who's got it right? The rest of the world, or is the U.S. Recovering greater and faster than what the market is only priced in? That's the million-dollar question. I seem to think that since it is a global economy, we need to be aware of why and ask ourselves, why is this overall stock market not moving with the appreciative valuation increases with the Russell, growth stocks, number one, and number two, the lack of volume. So now we said, okay, we blamed it on the summer. Let's get the games beginning. It's now September. We're going to have rollover. As you know, we've got quarterly option quadruple witching in the month of September, which will be next week. We have Wednesday this week. When the market closes, you're going to roll to December on the close. Okay? Tomorrow, we're going to have what? This Apple iPhone event tomorrow. So that'll probably take precedence on the news. There wasn't really a lot. We've got China's CPI and PPI to pay attention to. We have a 30-year bond auction on Thursday. The USDA crop production report. Friday retail sales is coming out. Not a whole lot to really say, let's get going. Here's some of the earnings that are coming out this week. As you can see, nothing that really stands out to get this market turned one way or another. So there isn't a lot there that we could pinpoint, is there a reversal coming for this week? But we certainly have some interesting events, namely the Apple iPhone event or the launch of their new products and their watch and all the other good stuff. So when I take a look at our scans for the week, and I say, all right, show me all the stocks that generated a daily buy with weekly buy signals. And I think, wow, look at some of the names that are in that listing. And I'll share with you, if I highlight over our scan criteria, you can see, show me a daily PPS buy when the weekly PPS is in a buy mode. And so Yum Brands has been in a weekly buy. It generated a daily buy. And I got to say, do I really think that I'm going to get invested in Yum Brand? SanDisk. SanDisk is in that space which peaks out this next week or so. And so while it isn't a weekly buy, and yes, it was in a daily buy, it's in a sector that kind of seasonally peaks out, and it might have a little bit more upside as we get closer to what maybe the resistance on a monthly basis and that midpoint of that major breakdown benchmark candle or Marabuzo that we would call it. And so midpoints often act as resistance there. Note that as the market's recovering, it's not recovering on a lot of volume. So I'd have to say a lot of the quality names that popped up on my list are just that, not that quality. We talked, interesting, a little bit about Best Buy, or maybe I did Friday on a radio show I was on Friday afternoon. And the funny thing is Best Buy's actually strategically made arrangements with little kiosks. I hadn't been in a Best Buy in a long time, and I went there and I saw a Google kiosk, and they're selling the phones and the products. Perhaps Best Buy might be a good value down the road, but up against this major red line of resistance, although it's in a buy, the volume looked pretty strong on a weekly basis. I have a hard time, as you may imagine, buying something at resistance, especially in this space with consumer, and maybe that's what that thing's going to boost them, is maybe that's what did boost it, is the anticipation that they're going to sell more iPhones or Apple products. I'm not sure. But needless to say, I find it, when I got my momentum indicator starting to show weakness, when I look at my volume starting to sidelines, I can't get excited about this. Let's take a quick look at Apple, because we noted, like, what was it, 2 Mondays ago, that Apple typically has a seasonal weak period of time, and it did have almost on cue a little bit of weakness. The funny thing is I look at this and I go, wow, we had a nice breakout, good volume, and maybe it's got more, to believe it or not, maybe it does have some decent value here. I see strong support, better support, down here at this 96 handle, and the fact is that Apple had this big down bar. It pulled right up into moving average resistance, and note that we're not forming a positive follow through. So for me, I get excited on Apple when we see a momentum shift to the upside, if it's going to continue moving higher. I liked Apple, as everyone knows, back in March when it was trading pre-split 535. I have a hard time buying Apple at 700 right now. And it's amazing how people lose sight of, nobody liked Apple. There was that book, and I often talk about it, and that everyone loves, no one liked buying it here, but everyone loves buying it up in here. So to me, I'd say for the risk reward, maybe that's good for someone that's got a lot of capital to work with. Maybe that's great for a fund that needs to be in it. But I think for an individual retail trader who's just looking to capitalize on a trade with limited funds, I don't think that Apple up here is a solid investment buy for the next 60 days, 2 months. Best time of the year to buy this stuff is actually in mid to late October, and that's about 7 weeks from now. So anyway, that's kind of a wrap up there. As far as the futures are concerned, here we have the market that, looking at the today's S&P trade, resistance comes in. First off, resistance for today, we still have this, again, it's amazing, 213.25. I've been jokingly saying we had some resistance that came in around 2014 for the year 2014. Kind of a funny number, but once again, here we are at that level. If we do get any follow-through strength, if we take out this last conditional change or the Friday high, which is this gray bar that you see here, odds favor the fact you got a little bit of a follow-through. The fact that we don't really see that weekly and daily volume, I don't know if it's a sustainable move. But it is, people feel as every day the market grinds higher, it's like they step their toe in the pool and they go, wow, it's kind of chilly, but I can deal with it, and they get acclimated to it, and then they go up to their knees, they get acclimated, they go up to their thighs, they get acclimated, and then they finally plunge in with everything they got. And I think that's the way the market is a good analogy right now. People are just saying, well, let me see if I get in a little, will it hold? And it does. And I get a little more, does it hold? And I think if people get fully committed to the long side up here, that's my fear. So the short term is still game on to the upside, no doubt about it. Two-sided trading is going to prevail. Maybe the fact is until we take out, and I mean this is kind of important, until we take out the, let me change this chart here. Until we take out on a closing basis this 88 level, which seems to be, I mean, on all accounts, I'd say, hey, this is a pretty strong support, a lot of tails, a lot of buying tails, right? But then again, I've got buying tails to the upside, rejection. We did Friday make a new weekly high close, a daily high close, so perhaps we could see, further upside. Another thing I wanted to warn against is that while the market looks like we could continue to go up, I'm afraid that once we do get a close under 88, it's not going to be one of these close at like 88 or 87 3/4, allowing you to get short. It's going to be one of these things where it goes just straight back down. It's going to be like one of these tall red bars that they just unleash the world on it. That's the kind of thing I kind of expect to see. So it's sort of like if you don't have longer term puts on a portion of your just a portion of some risk capital, very small portion longer term, and I'm talking going out to maybe January or so. We do get that seasonal sell-off. From where will we get the sell-off is the big question. But it doesn't matter. If you get a 20% sell-off, it'll still, be something that you're going to want something on. In the meantime, if we take out these highs, I think what we're doing or what we're starting to do is develop a broader based kind of top pattern. And as you start to look at this, you go, if the market is truly bullish, why do we keep selling off? We've got a lot of indecision here. Just one day Friday on the unemployment report, let's see how much follow through we get. Because if you were looking at this blue line down here, you'd say, if this thing was so strong, why aren't we breaking out? And that is one of my big concerns for you guys for this week. So even still, you take a look at the on-balance volume on a daily basis and say, it wasn't just this breakout Friday, it's been the breakout since the summer July highs. And that, my friends, is the overall concern. So with that said, short-term intraday, we seem to be a pattern that developed before last week was the market kind of opened a little higher, traded lower, went up during the day, and then the afternoon sold off as if they were buying them in the mid-morning session, selling them in the afternoon. Watch for that trend to continue. And more importantly, I'll keep you abreast of the bond spread, the knob spread. I want everyone to have a great trading week. And again, as always, if anything does happen that's monumental, we seem to, I have been putting out some decent tweets, and do apologize the tangent that I went on about the concept of people using personal smartphone devices in public restrooms, but it's something that I don't know why my sense of humor. I noticed that in airports more importantly, and it's just bizarre. So with that said, here you go. If you go up to the Twitter, not the nitwit, the twit, maybe it is nitwit, I don't know. But if you go up to Twitter and you follow that, or you want these, what I've done is put out some decent tweets, especially following through with you guys. Like we talk about TBT, we had a big thing about TBT and that objective. And so to liquidate, it gave us a shot of liquidating the long side. We went naked long the 58 calls off a bull call spread. So on a portion of the position. But just in case guys forget, I'll tweet this stuff out to you because we can't be following everything. The other day we saw PPS sell and last conditional or low close doji patterns on these stocks. Gilead Science had a big down move, but it snapped back up. It was kind of an interesting Friday. Let me point that one out to you, GILD. So Gilead Sciences, when you talk about a big snapback, that's a big long shadow. That's not a bad quote. But we got that Gilead Science, we got that daily PPS sell signal, and it followed through significantly. Did it give you a chance to take profits? I mean, it came with a sell signal near monthly support in a heartbeat. I think it was kind of hard to trade personally, but the true peak in price for this stock even doesn't come for a little while. So perhaps people thought that this was a very big value buy, but when you get that type of a breakdown, make no mistake, it's going to probably chop around and move sideways for a little while, offering on any rallies a maybe potential credit call spread heading into the September triple witching expiration. So they just wanted to follow that up with you guys. That concludes today's session. I'm sorry we were long-winded, but we had a whole lot there that I was not using my cell phone. It's that I notice others doing it. Thank you, Sonia. In any event, thank you all very much, and you guys have a great trading week. Now, I will be in New York. I'm not sure if anyone's coming to the event in New York. We are also speaking here tomorrow night in West Palm. So if we got any people that are down in the Florida area that are near North Palm Beach, you can come visit us over tomorrow night. Just, I think we'll send an email invite out today to give you directions, or just send us an email and say you're interested. We'll be at the New York Options Conference, and I'll be flying in on 9/11. I will be leaving, speaking on 9/12 and leaving 9/12. So I will be in New York City for 24 hours and wish to see everybody that'll be popping in, at least to say hi at the Marriott Marquis. And that's what our plans are for this week.